Welcome to Surgeon Syndicate. If you're paying attention, you know that you only make money when you work. It might be great money, but it's dependent on you. The information on this podcast will help you solve that. We interview experts and provide analysis into financial freedom through commercial real estate. Why? To help physicians like you thrive. Let's dive in.
Welcome to Surgeon Syndicate. This is your host, Dr. Michael McManus, and today we're going to discuss subject to real estate transactions. This is a type of deal that allows the original mortgage to stay in place. So it's another way that we can kind of look at different ways to get deals done and where they come from and what this might all involve, whether you're a passive investor or an active investor. This is something to know about from a passive perspective, because if somebody's doing a bigger deal along this and they're looking to bring along investors, it's something that you should know about so you're aware of kind of how these work. So again, today we're going to dive into subject to, or sometimes called sub to, real estate transactions and how they can be used as a form of leverage to grow a portfolio. So basically, a subject to transaction is a real estate acquisition method where the buyer takes over the seller's existing mortgage without formally assuming the loan. The title of the property is transferred to the buyer, but the mortgage remains in the seller's name. So this strategy allows the buyer to control the property and make mortgage payments without needing to qualify for a new loan, particularly useful to investors looking to minimize their initial cash outlay and avoid the traditional financing process. So how does this work? The process typically involves a transfer deed to the buyer while the existing mortgage remains in the seller's name. The buyer takes on responsibility for making the mortgage payments. So it's important to ensure that all payments are made on time to avoid risk of foreclosure or risk of the bank becoming involved actively in the deal. The key documents involved are a purchase agreement outlining the terms of the deal, a deed of transfer document, and potentially a power of attorney to allow the buyer to communicate with the lender if needed. Why would people want to do these? So for the investor standpoint, it's got low entry costs. You can take over an existing mortgage, avoid a high down payment, and avoid closing costs associated with new loans. You can do it for the speed of the transaction because these can typically close quickly and bypass some of the lengthy loan approval processes. There's not necessarily a credit check, so credit score is not as big of a factor. But for the seller, anybody selling on one of these really would want to know about the credit of who they're selling to, because they're still going to have their name on the mortgage. So it will be important who they're selling to and their credit worthiness. This can also benefit the investor from immediate cash flow. Because there's not as much expense getting into the deal, it could improve cash flow from a few perspectives. One, you keep more cash initially, so that improves returns. If you're assuming a loan at a lower interest rate, which some of the older ones are, so this is important now, it can decrease your payments, which also increase cash flow. Some of the additional financial benefits, again, is locking in older rates, especially if those are significantly below market. And it can also allow you to leverage your capital more effectively, because this is a method of acquiring properties that sometimes you can decrease the amount of your down payment. Now, a lot of times when these are mentioned, they're talked about with no down payment, but this is a deal with the seller, and the seller may want some cash up front on this deal. So why would a seller do this? This looks like it benefits the buyer, not the seller. Well, this is mostly for motivated sellers or under pressure sellers. If they're at risk of foreclosure, they're trying to avoid foreclosure process or even any mention of foreclosure, which could damage their credit score and their reputation. It's also a method for a quick sale. If somebody needs the cash, whether it's for an unplanned expense or whether they want to get out of this property because they have a new opportunity, a better opportunity, and they want to move it quickly, it can lead to a very quick sale. Other could be debt relief. Whether we're talking an individual seller or an investor, there are people right now, as they see rising interest rates, who have gotten into trouble. We're not out of the woods on this yet. There are people who are struggling along and surviving maybe hoping for lower interest rates down the road. But this whole change in interest rate environment is still going to play out over the next several years. I don't believe we're going back to 5% interest rates and lower. And we're now in like what is really the norm for interest rates. And so the higher, longer mantra, I think, is where we're going to be. So when I was looking for some examples on this, of where people have used this, you do typically see this more if somebody's buying single family homes. That could be if a homeowner loses their job or they have a big expense and they don't want to face foreclosure. So this, would be looking at, stressed sellers. But you can also find these types of deals with commercial investors. Something could have happened with this property or even another property or something else in their life that creates a need for cash right away. And depending on how things go, they may need to make a quick sale. And if you can sell a property and maintain a lower interest rate you already have, that's appealing to buyers. So you'll attract more buyers if you can manage something like this. And so it is something that may be possible with commercial properties, not just single family. Now, what does the bank think about this, or the mortgage holder? They typically don't like this idea, especially your traditional banks. They don't like the idea of one person owning the property and somebody else named still on the mortgage. They prefer to see a new mortgage, even if they're going to waive any fees. This is just, and I've talked to my bank a couple times about trying to pass along a lower interest rate to a buyer, and they've really been a no-go from the beginning. But why would the bank be involved? What would motivate the bank? Really, when it comes down to a distressed seller again, because if they're worried about a foreclosure, if they've got too many bank-owned properties already, if it just by moving this along in this fashion, if there's a way to make it good for the bank too, the bank is going to be less likely concerned about it. And so if they see a property that they're worried about being able to resell if they foreclose, or they're worried about how it affects, how the bank looks to the Fed with the number of bad loans they have, that would be their bigger motivations for keeping something like this going, where the note stays current and they continue to see payments, but also they don't have to have a foreclosure or any foreclosure proceedings on their book, which, especially if it's commercial property, can look bad for the bank. So if the bank doesn't like this, what can they do about it? Well, most mortgages have what's called a due on sale clause. And basically what that says is if the property is sold or transferred, then the mortgage is due and payable, and they can call that loan in immediately. And this should be one that if somebody's trying to do one of these deals, especially if you get through it without involving the bank, if the bank finds out, should be prepared to pay off that loan and refinance if necessary. So, I think this is one of those that going down this road, what's your worst case scenario look like? Isn't it still a reasonable investment? And what's your best case scenario look like? And because this is a little more complex, this isn't like a 5-cap deal here. This should be something that really pays well and makes it worth the trouble and the risk. So just remember, the banks have a lot of leverage here, and the banks usually have very good contracts with their mortgages, because this is what they do is they lend money and they want to make sure they have sound backing for the money they've lent. So again, what's the benefit here? Banks typically prefer traditional transactions. But again, if the original borrower is struggling with payments and the bank is more motivated to keep this mortgage current than anything else, that's where they're going to be most likely to want to go down this road. Again, if they're worried about any of their regulatory bodies being concerned about their portfolio or the bank's investors, a lot of smaller local banks or regional banks may have a core group of investors. And if the bank's investors are telling the bank management, we don't want a bunch of bad properties on our book, this could be a situation where the bank becomes more motivated. Now, when I think about situations like this, the biggest thing that comes to my mind is office properties, especially if you have an office property that's in trouble. The bank doesn't want an office building if the bank's going to have a hard time selling it. Banks don't mind foreclosures as much, like in a hot housing market where they can foreclose and sell it the next day. But if it's a tough to sell asset and they've got a bad loan on it, this is where the bank may be more willing to look at more creative things. So where do you find these types of deals? This really comes down to the wholesaling business, which you see a lot more in single family homes. And those are the sides that you see, the we buy ugly homes or we pay cash, that are basically, again, looking for distressed sellers. Where could you find non-residential properties like this? A lot of the same things, some of those that are doing this with single family, they're wholesaling. That's the word I was looking for. Wholesalers who will do this with single family homes. Some of the things they do that you could also do to find commercial properties like this is sending out mailers to the property owners. If there's a very specific area you're in, you could even stop by and try and talk to the owner. Or, if it's a business that's leasing it, you could find out who their landlord is and see if you could get in touch with them and talk to them directly. These phone calls, and more than just like a mailer, often are the things that make people think. And they may not have even been thinking about selling this building, but they go, maybe I would like to sell this building for whatever reason, and might start them thinking about it. Other places, public records, online listings, where you can find out if properties are in free foreclosure. Networking, that's, building relationships, not only with other real estate investors or wholesalers, but also with bank lending agents, where the bank may say, we want to get this loan out of weak hands and into strong hands. Because if the weak hands, if people are struggling and they have somebody else who's got the reserves to turn this deal around and not go to foreclosure, that's really in their best interest. So that's another place that sometimes, by having connections with loan officers at banks, that they can bring these deals to you. The marketing campaigns, like we talked about, online ads, direct mail, social media, you see all these things where mostly they're usually looking for single family. But, social media, this is an interesting one because your social media outlets know a lot about the people who are out there. And this might be a place that says, if people have stuff in their social media about owning commercial properties, that's who you'd want your ads to land in front of. So might be an interesting place where social media could actually be more beneficial than some of the others. So legal considerations, due diligence here is very important. Verifying the mortgage terms, including the interest rate, the remaining balance, prepayment penalties. If the mortgage is up to date, documentation from the bank that is recent that shows that there's no issues with the loan currently, or if there are issues, that's when you need to communicate with the bank on what it would take to resolve and make this mortgage current again. And with any purchase, liens and encumbrances, but you're going to more likely find liens on properties if you have a seller that's already in a little bit of financial difficulty. The contracts and documentations, again, these are kind of the simple. It was there in the early part, we talked about the purchase agreement, a deed transfer document, a power of attorney. And this is also one. This isn't legal advice, but get a lawyer on this. This is not one to do. The number of people I've heard recently who have talked about doing deals without an attorney, especially something like this, get your ducks in a row. Have a good attorney, have a good real estate attorney. Make sure your documents are solid, especially if the bank later on decides that they're unhappy with this arrangement. The last thing you want to do is have bad documentation. Again, that's understanding the due on sale clause and the enforceability of that. You're going to need a lawyer for that. Your title insurance, making sure that you can get a clean title. One other consideration here, we haven't talked about this on the show for a while, is an entity transfer. Some states and even communities' entity transfers are rather simple, and in other ones, they're not, and they sometimes won't let them through at all. Usually the point of an entity transfer is that you're buying the LLC that owns the property versus buying the property. And by buying the LLC, you don't see a change in price of the property, which can affect taxes. There can be some other things involved with that. But that, again, as we just talked about with lawyers, is really the important thing in making sure you have all your legal documentation done right. So I hope this has helped, maybe opened up a new door for you, or if you see this term sub to transactions or subject to transactions, that really has a way of is another way of capturing a property, trying to capture a pre-existing mortgage, either because you can make it happen fast, but a lot of the time here is to capture a better interest rate from an earlier environment. If you have any questions about this or want to talk about it more, reach out. You can go ahead and schedule a call on surgeonsyndicate.com. I'd love to talk to you about real estate. If you're looking at exiting medicine, any of these things here, and just find out more about people who are listening and whether they want to hear more about. So again, I hope this has been some value to you, and join us again next time on Surgeon Syndicate.
This has been an episode of Surgeon Syndicate. If you got value from this episode, you know other surgeons are hungry to become job optional, and you can help them by sharing this content today. Schedule a call and we can make a plan. Looking forward to having you with me on the next episode.